It's an honor and a privilege, and the second only woman so far. Well, we're going to have 2 women in one day, so that'll be, that I can figure out at least. So it'll be pretty exciting times. Great privilege to be here speaking to you. I know where the ask is for a stock pick, but I think the best pick in the marketplace today has to be the value investment style. So I really want to spend most of my time talking about why I believe owning value right now is particularly appropriate and a total value buy in this particular market, and then drive it down to highlighting that investing in largely Europe and Canada is a much better opportunity for investors than being in the US today. And then, of course, driving it right back down to within one of those markets, obviously Canada, an area I know well, highlighting Suncor stock very briefly at the end. Sionna is a boutique investment manager focusing in on equities, largely Canadian clients, Canadian focused, but we also have international and global opportunities and a resource fund as well. I've been in the industry since '83. I launched the firm as a sole founder for reasons to not get sued by the firm I was leaving back in 2002. So we're, as I mentioned earlier, bottom-up value people, and we value people don't tend to look at top-down macro features because we think that buying cheap stocks is all we really need to do. And so we tend to ignore. We hear Warren Buffett talking about how I don't really care about what's happening with the economy overall. And we would agree with that, but we also think that it from time to time it behooves value managers to step back and look at macro factors to see the big sweep of what's going on in the marketplace for what messages it can give us to tilt position sizes and focuses in portfolios overall. And I also think it's very helpful, particularly since value's gone through a very tough drought period, to be able to explain to clients why your style is struggling and also to give them hope for the future. And I think there's a big opening here for value, and I think it's worthwhile to be pitching that to our clients overall. So I don't need to tell you this. Value's been struggling for quite some time. This chart is showing you that value peaked in terms of AUM back in 2006, and it's been weakening significantly since then in client portfolios. Value, even though in the sweep of history we know value outperforms the growth approach, value has tended to never be more than 30% of an equity allocation, partly because it's psychologically challenging to be investing with value investors. We're contrarian. We buy stuff that people don't want to hear. I think the speaker just before me was incredibly courageous by focusing in on a tin can company. So most of us would sit back and say, hey, I don't really do that. But when I started going through my own closet, I saw my own cupboard at home. I saw how many tinned, cans of pumpkins and cans of tomatoes that I have in my cupboard. So I'm still buying them. I don't have to be low income to do that overall. But the allocation is very low. So this is clearly a contrarian buy here. And of course, we value managers adore contrarian buys. So let's go back and look at the history of value. And it's only a century long. It's taking the classic long-term data series going back to 1926, using the Shiller PE multiple analysis. So the first dot on the page is 1936. Each point on this chart is a 10-year average return. How you read this chart is the histograms above the zero line is value outperforming. The histograms below zero is the growth style outperforming. Obviously, taking a quick look, you sit back and you go, value's the game. Value wins most of the time. But, what's this curiosity here? Why does growth outperform in this barbell effect? Why did it do so well in the 30s? And why did it do so well recently? And when is this going to end? And what lessons can we take for this overall? So how do markets really work? And most people will sit back and say, well, it must be earnings. Earnings are everything. Well, bank credit analyst studied about 17 major developed nations over 112 years and said, how important are earnings? And they said, well, if you knew GDP, looking backwards in history, if you knew what GDP was, how much does it explain stock market behavior? And by definition, GDP, gross domestic product, equals gross national product. Gross national product is the earnings income of all the businesses in the economy, and the stock market is a subset of that. So earnings only explain 17% of stock market behavior, was their conclusion of over 112 years. More recent studies have looked at this, and they're saying that earnings are explaining even less than that of stock market behavior. So what is going on in stock markets? And I think sorry, that bounced ahead on me, and I'm trying to go backwards. There we go. Is you see the market have bull phases where you have strongly rising stock prices, and then you get consolidation phases, which are what we would call sideways markets. And I think when you look at market returns in history, you see that you get a big clustering of single-digit returns. That's in the sideways markets. And then you get a big cluster of double-digit high-teen returns, and that is the bull phase of markets. And there seems to be this phasing that goes on in markets throughout history. And if you're really interested in the topic, my good friend Vitaly Katznelson wrote a great book on sideways investing, and he gave a lot of really excellent data about the fundamentals of each of these kinds of markets and how to make some forecasts about it overall. So let's look at the last full sideways market that we can see and see what it can tell us about what's going on in the market. Now, you go to the very far left-hand side of the page here, and you can see that bull phase. Now, it started in 1941. It's capturing it from 1950 on. And so the blue line's going jauntily up, lovely. But what's going on below the surface? And that's the soft gray line. Now, I'm going to ignore the red line, and that is commodities. And I'm more than happy to talk about it because I operate in Canada, and we have a lot of commodities in Canada. So I like to follow what's going on with commodities. But that soft gray line is the PE multiple. So in a bull phase, people are getting so enthusiastic about investing in the market, they're willing to pay more per dollar of earnings to play the game of investing over and over again. Until we reach this magical point where everyone changes their mind and we enter a sideways market phase. And the overall markets go seesaws in a roughly sideways market pattern, as we saw in the earlier chart as well. But underneath the surface is PE multiples are coming down. The enthusiasm is slowly coming out of the market. The balloon is deflating. And why does it take so long for sideways markets to unfold? It's because falling prices are psychologically painful. Investors don't want to accept their losses. They often anchor on the price they paid, and they hang in and hope for the best. Occasionally they'll sell, but not always. And so you get these lengthy sideways markets. So let's go into a major sideways market in a little bit more detail, and that is the 1966 to 1982 sideways market. And the overall market return for the S&P 500 was just under 6%. So, that single-digit sideways market style return overall. But I think this audience in particular will be quite fascinated to see that value style of investing did extraordinarily well and was able to really shine as PE multiples were collapsing. Because who feels the pain of those collapsing PE multiples? It's those growth managers. They're taking the hits. They've got the expensive stocks that are unwinding and coming down, we value managers tend to own the cheaper stocks, and they can sort of just meander along, and slowly increase in value throughout a sideways market and make real returns. And that's so unexpected by investors and so appreciated. So what is the driver of these changes into sideways markets? And we have to really go into the bond market. And I do want to give a little bit of a lesson. I know we're exposed to bonds, but a lot of people don't realize how bonds really work. The comparator asset class for equities is 10-year government bonds. It's how we price equities overall. And we're giving you a fair amount of history here. And we're showing you that these bond cycles, like when bond yields tend to go up for a period of time and when they tend to go down for a period of time, they're roughly 20-year cycles, let's say 17 to 23 years. Occasionally they're much longer, and usually that's after major wars. After the American Civil War and after World War II, these cycles can be longer. They tend to be symmetrical. So just making that point really fast, and then let's apply it into the markets. I am more than happy to make these charts available, by the way. So no problems there, I'll share them. This comes from Ned Davis Group, a firm we quite appreciate. They look at financial market history so that you can learn lessons from that macro history, those big sweeps of what's going on. I'm going to focus in on the top and the middle bars. So let's start with the middle bar. This is showing you bond yields, the polar opposite of bond prices. Whenever you see green on this page, it means it's a bull phase for that category. So the most recent period, lengthy period here was a green phase. Bond yields were falling, which meant bond prices were rising. It was a bull market for bonds. And then the top of the page is the equity markets. And I'm going to make a really bold claim here. If you haven't seen this before, it took me a long time to see it actually, is that when the bond yields change direction, typically once every 20 years, sometimes longer, it ultimately impacts the equity market. And so what I did was I conveniently added to their chart the vertical lines, showing you when that bond yield. So you'll see it's correlated to when the bond yield changes, and then you see a little bit of a gap, a little white gap, and then you see the equities entering their bull phase. And then they go into a sideways phase. So for a 20-year plus bond cycle, whether it's going up or down, you will see an equity bull and a sideways within that. And so let me just not go into too much details yet, but carry along in this story overall. The commodities are at the bottom of the page. They tend to be the polar opposite of equity, so where equities are green, commodities are white, and vice versa. The only major difference I'm going to highlight here on this page for those of you who are interested in commodities, because I bumped into a lot of you last night, is that when you enter an inflationary period, commodities tend to have an extra 10-year long cycle overall. So that's a very big positive for commodities today. So let's go back to the famous FAMA French 100-year, century-long data series and add that vertical line of when interest rate changes happen. And I think it puts this picture back in a greater focus for investors overall. And so now it's easier to understand what's happening and why growth markets outperform in the barbell shape. Because we had an incredibly long interest rate cycle. From 1941 to 1982, we had a very lengthy inflationary period for a lot of interesting reasons. They tend to be symmetrical. So we just went through a 40-year disinflationary cycle. And I've been in the industry 40 plus years. I started in 83, and I didn't even operate in an inflationary environment. My entire CFA was about inflation, because that was the last big boogeyman. But very few people in this room, if anyone, has actually worked in an inflationary environment. And so it's not surprising to me that most people really don't understand inflation. And if you look back at this chart here, That was a stagflationary period, which is very similar to what we have today. A weak economic environment overall, but with inflation. Inflation is north of 2.5%. Professor George Athanasakis at Western University here well, not here in Canada, when I'm normally there, he studied the Fama French data series, and he said, how does value do when inflation is north of 2.5%? And inflation's north of 2.5% just about everywhere today. And all of these tariffs are not going to create disinflation. They're likely going to contribute to inflation everywhere. So I think our future forecast is that we have inflation north of 2.5%. And so that we are in a beneficial period for inflation. And his conclusion here, he wrote an 86-page academic research report if you want to read it, but the fast conclusion overall is that value outperforms growth by 11% annualized, which should be welcome to most ears in this room. So how has value done since rates bottomed in the summer of 2020? This is very much like 1941. 1941, Pearl Harbor happened. America entered the war the next day, and the next year inflation was 9.5%. Sound kind of familiar? You know, in 2020, COVID happened, and globally, governments threw money at the markets to stabilize economies. It was like wartime spending, and they kicked off inflation. So it'd been a pretty long cycle. We were waiting for that moment for rates to change. People tried to call it in 2012. They tried to call it in 2016. It's pretty clear to me that, you know, we hit the low in rates in the summer of 2020. And so the 4 years since, value, we have had what I'm going to call a stealth value recovery in the U.S. And the U.S. is so dominant, they keep saying, well, it's still a growth game, but that was the Magnificent Seven hiding what was really happening overall in the marketplace, largely pushed on by the development of AI. And there seems to be a pullback on the enthusiasm around AI, like there is on a lot of technologies. We tend to get too enthusiastic too early about them, and they need more time to really develop and evolve into the economy. But we're seeing in both Canada and international markets that the value style has been outperforming, and we expect it will outperform likely for the next 15 years or so, since these cycles tend to be roughly 20 years, and we're 4 years in here. And this is, again, looking at the Shiller PE multiple. It's 140 years of U.S. financial market history. You break the market up into deciles, and the cheapest deciles of the U.S. market history was in your far left, and that little green line is the average return. So you get really good returns when the market's super duper cheap, and you get really lousy returns when the market's very expensive. So right now, the U.S. and the global markets are trading at some of the most expensive levels, or were recently in financial market history, and have a 1% expected return, exactly where we were back in 2000. And in 2010, the total return to the U.S. stock market was 1%, totally forecasted by financial market history back then. So those markets are to be avoided, especially in a stagflationary environment. That's not going to give you a real return for investors. So where should investors be hiding? Well, in international and in Canadian markets and others that are much cheaper. And then for the value managers in the room, and we put ourselves where our PE multiples are sitting, much better than our own home market, as would be the case for most of you sitting in the room. You're going to get a better return than your own home market because of the pricing structure within your own portfolio. And with value outperforming, you should be able to get that kind of return we saw in the 66 to 82 time period overall. So what does macro value investing teach you? It suggests that value is likely to outperform, that commodities likely have an extra 10 years here, that active management should beat passive management, and that you should be trimming the US market and buying Europe and Canada to be defensive, and then adding to those contrarian value managers, those underinvested area, that the average investor owns 5 to 10% of their portfolio in value, and they should be taking that up right now. But we all know they won't. That's how history works. They'll wait till we get really great returns like we did in 2022, and then wait for that to be in the can and lose the easy money. But to the degree we can encourage them to make the move, that would be terrific. So then coming back into Invest in Canada, what name would we be suggesting? And we wanted to focus in. I work with 8 other investment professionals. One of the large cap Canadian stocks that looks most attractive on our models and is a significant weight in our portfolios overall would be Suncor, a large oil sands producer in Canada. In fact, they invented oil sands investing several decades ago. It's basically where you mine for oil. It's very, very long life assets, very low cost structure overall. And, the new CEO who came from IMO, giving this, the stock's very cheap. It's trading below a 10 PE multiple. One of the big shockers in this new world is that oil companies are not spending a lot of money trying to find oil. They're trying to maximize returns to shareholders. So they're all high-paying dividend stocks now, including Suncor, at 4.3% dividend yield. And it's only below 50% payout ratio, so it's a pretty stable yield overall. So we think it's a great stock for people to consider if they were thinking about investing in Canada overall. And we know that the shale operations have a very rapid declining life. There's a lot of years of resource left in northern Alberta, if you ever want to go up into the cold parts of Canada. So why don't I stop here and see if there's any questions?
Thank you. Any question? Yeah.
Thank you, Kim, for a great presentation. When you talked about the sideways markets and the value outperforming growth, I'm wondering if there's data in terms of that outperformance, the 11% that was mentioned. How much of it is coming from change in multiples versus the operating performance of the underlying companies? So how much of it is purely sentiment versus these companies have actually done better than growth companies?
Yeah, you hit on something really interesting, and I saw that kind of question pop up a lot in 2022 because it'd been so long since value had outperforms. Most people didn't understand what that's all about. Value outperforms when growth is getting creamed. So those stocks are collapsing much faster than, value stocks are going up. I heard a lot in 2022. How come value is outperforming? I don't see any of these stocks shooting to the moon. Well, we just tend to do what we've always done. We incrementally add returns, continue to go up, continue to pay dividends, do better, while the most expensive stocks out there collapse down to more normal valuation levels. Hopefully that answered your question. They're constantly going up, these value stocks. They're just not doing it in a sexy way.
Thanks for that. You packed in so much information there, you're definitely going to have to send us those slides.
Happy to. And please sign up for my website. I've written on these themes many times. I've never taken anything off, so you can see what I've thought in the past and today. I mean, I've done this speech many times since 2003.
The thing that's on my mind is that the world we're going into isn't covered by what.
One second.
Yeah.
Yeah. Sorry, the on my mind is the concern that the world we're going into is not covered by what we've just talked about. And your data and all the data that's been studied doesn't take account of a world where inflation is high and volatile. So you have periods of rising and falling, and so this future of inflation volatility is going to mean a very different world for the performance of 60-40 portfolios, but also for equities, because if you've got high and falling, high or rising, you could be losing or making money on equities. So it suggests to me that the asset management world has got to have different techniques and instruments in order to navigate that world. And maybe for the room here, it's more about being active and changing your positions than it is about buy and hold in the future we're going to have.
So you're talking about timing, are you? I'm just going to play back.
Not timing the market, but timing the probabilities, because you don't know. So why would you take a view when the valuation suggesting you no longer know? Because that's what will happen. We'll get this spike for a couple of years, and then you're going to have to do something to protect your portfolio. So that kind of, it will work well in the data because it will basically capture volatility in a trading quartile mechanism, but that's not how people tend to invest in this room.
You're right about this. Well, hopefully you're wrong, because this is called a value conference. So I'm presuming there's more people in the room that do believe in value. There's a lot of value turncoats out there, and it's entirely understandable because, since 2011, value has underperformed and been challenged. So, and you look at the allocation of value historically, was very low today. But I find that it's very hard for many managers to consistently market time well. And I think that there is a very lengthy period here where value will do quite well. Now, that's my opinion, and we'll get to see how the markets unfold. But there's a lot of history here. 80% of the time, value has historically outperformed. We've just had a recency bias, and you take a look at the age profile of the industry, and it tends to be a young industry. And, I know that I was a past president of the Toronto Society of Financial Analysts, so I see this as a CFA event as well. And I question what your age profile is, but I know in Toronto, the age profile of members over the age of 50 is less than 10%. So there's a lot of people, like I even see it in my own team, who've actually, I've got portfolio managers who've been working with me for 11 years who have not really seen a true value market in their careers. They got to see 2022. That was really good stuff. I mean, virtually every single one of our funds was outperforming the benchmark by 8 to 12%. That was a great year, and it's been helping our 4-year numbers. But, I don't know about you sitting in the room, certainly for me, from January on, this is 2022 redux all over again. This has been a great market right now, and I think it's going to last for a while, but we shall see. But I imagine there's many, many investors like yourself who are trying to market time and think that's possible. We'll see.
Yeah, hi. Thank you for the great presentation. Could you talk a little bit more about the Suncor opportunity, specifically in terms of capital allocation, whether capital is being allocated to growth CapEx, or is it more of a question of monetizing existing assets?
Well, let's do this one at a time, if you don't mind.
Sure.
So capital allocation, well, we had something called ESG happening around the world. It seems to have kind of melted away a little bit right now. But, there has been a change in focus in most commodity businesses to return capital to shareholders and not do more development. And that has certainly impacted companies like Suncor, for sure. And now they are advantageous in that they have a very long life asset. So they don't have to go out and find and explore. They just have to start mining different areas around where they're already located. That's one of the reasons why the dividend yield is so high today, is because they've been increasing the dividend and doing share buybacks. So it's a different capital allocation scenario than it was a decade ago, even for Suncor. And as you know, Elliott came after them and said, we think you can run your business more efficiently, and they've got a couple seats on the board today. And there is a new management team, Rich Kruger from IMO. IMO's always been known to be a low-cost operator, IMO being Imperial Oil, owned by Exxon. It's 67% owned by Exxon. The largest oil company in Canada is Imperial Oil. Most Canadian investors don't even know it because it has a smaller float, because the U.S. entity owns 67% of the firm, so it doesn't trade. It trades like a mid to small cap stock. Almost no one writes a report on Imperial Oil. But Rich Kruger is, a really seasoned CEO, and they have improved their efficiencies at the operation. This year, they recently did a coca drum replacement, and they did it on time. And I think that's given people a fair amount of comfort that they're better managed than they had been in the past, by not, having cost overruns and taking longer. And yet it's still trading at a discount to its peers. If you look at Suncor, it peaked at $60 a share. It's trading, well, let's see, who knows how it traded yesterday, but it's been trading about mid-50s. It peaked at $60 20 years ago. We think it could be an $80 stock, so we think it's good 45% expected return, and it's got a juicy dividend yield as well. So, we think there's a lot to like in a stock like this, and it's a large cap stock. With a better management team and greater focus, and even Elliott has sort of said, yeah, no, you don't have to sell your downstream. We can see how efficient and wise that is to keep that. So they pulled back from some of their recommendations.
Thank you.
Last question, please.
Yes, thank you for your presentation. You mentioned at the beginning the evolution of inflation starting to kick up, and then value investing, and then also you mentioned commodities. And the question here is, we know that in the current environment, stocks trading in the commodities areas, they are mostly valued. But did you make a study between the commodities and the stocks in working in the commodities field, to see if at the beginning of the inflation, where was it better to be? Was it better to be in the commodities, or was it better to be in the stocks?
Whoa, that's a good question. So my charts here only address being in the stocks. No, that's not true.
Because you had a small mention, one chart where you mentioned the commodities that start to...
Yeah. The bottom third here is commodities, but it's the CRB index, so it is the commodity itself, not the stocks. So you'd have to kind of take into account somehow a mosaic of what's happening at the top of the page. But that commodities, like if you look at 1941, normally, see at the end of, in 1981, when rates changed, peaked and came down, you can see the commodity cycle ended, went from green to white. So that was a change, and it was aligned with what was happening in the equity section, because they're polar opposites. Commodities are fixed or hard assets. So you can also align commodities up with things like arts, intangible fixed or hard assets, and real estate. Not always exact, and there's little edges around it, but by and large, that fits in. But when you go back to 1941, because there was a war going on, war demands a lot of commodities. And then post-war, you have a lot of rebuilding. And so there's a lot of spending on commodities, so that they tend to go an extra cycle. And you saw that back in the aftermath of the American Civil War as well. So there has been, even Ned Davis Group several years ago wrote a piece about why they felt that the commodity cycle should be able to extend an extra 10 years here. Now, this was part of the emerging markets coming into their own and joining developed nations and spending a lot of money on commodities, which we certainly saw happening. But the cycle took a bit longer than most people thought. But we are certainly seeing commodities doing well here. And it's a bit uncertain how long, but the best guesstimate is to look at what happened in the aftermath of 41. I mean, this is not a statistically significant sample given the long sweeps of time. It's very hard to go back and get good granular financial market data historically. It's just not out there. You can't get more history on value versus growth than 1926, because even though there was stock markets around, in the US in particular, back to 1800, you don't have the old financial statements. You can't say, at this moment in time, this stock was a value stock and this stock was a growth stock. The furthest back you can get in sort of a granular fashion is, there's another reason why AI will not be able to do active management anytime soon. I've won 2 debates on this topic because data was so expensive to store, it was dumped. Literally dumped. You need millions and billions of data points. Inter-day prices were not saved. Prior to 1971, it's very hard to get much data on capital markets. And it's very hard to gather old financial statements. So people are trying to pull it off, but it's not there. And so without all that data, AI won't be able to replicate our human minds for a while, but they'll get there.
Okay. Thank you so much.
Thank you.